Hello and welcome to the Muni CreditCast, BAM Mutual's monthly discussion about the questions investors can be asking about the credit quality of their muni bond portfolios. I'm Mike Stanton here with BAM's Chief Credit Officer, Suzanne Finnegan, and together we're going to hit a new milestone in podcast development, our first Ripped from the Headlines edition. Suzanne, we're entering into hurricane season, and the long-term forecasts are predicting it could be a significant one. We've already seen one major storm, Hurricane Beryl, inflict significant damage in the Houston area. So for today's podcast, we're going to talk about natural disasters in municipal credits. And so our first question for you is, if you're a bondholder and you hear that a hurricane is bearing down on a community where you hold debt from, what are the questions you need to ask, and when should you be asking them?
Well, you should probably be asking them before you buy that bond, Mike. There are certain regions of the country that are very much more prone to these risks than other regions. And so you do need to look at the individual credit and what the potential impact of one of these natural disasters could be. Some of the things we look at is how large of an area does an issuer encompass. So the impact of a hurricane or a flood in a county would be very different than the impact of a hurricane or a flood in a small city. And so we try to evaluate the relative risks of those events and how impactful it could be. Unlike for municipal bond insurance, unlike property and casualty insurance, if one home is damaged, it doesn't mean the municipality can't pay its debt. So damage would have to be significant and relatively widespread to have a true impact on the underlying credit.
And so that's a really great point. So I want to take a step back, because we've talked about hurricanes, we've talked about flooding risk. What other kinds of natural disasters do you think about in the underwriting process?
Well, so the other two main disasters that we consider in our underwriting are wildfire and earthquake. Earthquake more specifically in the West Coast area, California, but wildfires really are popping up in more places than we've seen historically. More of a concentration in the West, but it's a risk in most places. And I think we think about the probability of one of those events and then what the potential impact, if that event occurred, what that potential impact could be. We think about not only just a city, but a greater geography. So if you have multiple cities that are near each other, more than one entity could be impacted by one of these events.
So we've made it this far without mentioning explicitly the podcast tagline, but I think this is the right time for it. If you've seen one muni bond, you've seen one muni bond. So is that relevant to this discussion? You know, we've talked about the fact that earthquakes, hurricanes, they can both be very large events and cover very large areas. There could be dozens or more of issuers within the affected area. Is this a regional issue, or is this still something where you have to look at the individual transaction?
Well, you still have to look at the individual transaction. So you have to look at the underlying source of repayment and whether that source of repayment is going to be impacted in a way that would leave the issuer without the ability to make their debt service payments. And so, again, that's going to have to be a pretty significant impact for that to happen.
And are you looking at the actual infrastructure itself? Are there specific projects or things that could be more or less at risk?
Yeah, so obviously facilities that are located in the higher risk areas, so on the coast, are more likely to be damaged in a hurricane, for example, or facilities that are located near a river, and many water and sewer treatment plants are located in those areas, could be impacted by flooding. And so it is important to know, if you're doing a revenue bond in particular, where the facilities that generate those revenues are located.
Great. Well, that's really helpful. I think this is a good time to go ahead and start talking to our guests. We have two guests today, both from inside BAM. We have Mike Weinstein, who heads BAM's surveillance department and is the lead person charged with monitoring and responding to storms, most commonly, but all kinds of natural disasters. And we'll also be joined by Laura Levenstein, BAM's chief risk officer, who will talk more broadly about how we manage these risks at the portfolio level and think about them kind of on a nationwide basis. So let's take a break. We'll bring our guests in, and thanks for your time, Suzanne.
Thank you.
So we're joined today first by Mike Weinstein, head of surveillance here at BAM Mutual. Mike, thanks for joining us on the Muni CreditCast.
Thanks for having me.
So can you take us through the process of what your team does when a hurricane is forecast to strike the U.S.? Are you sitting at the computer hitting refresh on weather.com? How does it work?
Sure. Well, we don't use weather.com so much, but we do use NOAA, and they have pretty good forecasts that start tracking storms as soon as they're brewing, either in the Caribbean or on the West Coast. And we follow them as soon as they form really into a tropical storm and monitor whether they develop into a bigger, more powerful storm that's heading towards the United States, or whether they turn and go more offshore. So we are following them and follow the potential path where they could hit an area, and whether we have exposure in those areas or not determines whether we, how closely we follow them as they progress.
And is there anything proactive you would do? I mean, is there a role for you to play in reaching out to issuers ahead of landfall?
Sure. So once we have a sense that there's a possibility that an area of the mainland is going to get hit where we have exposure, we look at where we have upcoming debt service payments due for bonds that we've insured. That's our short-term focus of really the issuer's ability to make those debt service payments if the storm is going to hit near a interest or principal payment date.
And that's a really important point, that there's kind of two layers of risk that is being managed here. Suzanne talked earlier in the podcast about kind of the longer term risks, the impact on the issuer's ultimate ability to pay. But BAM Insurance also covers the short term liquidity issues if a payment is due in the immediate future.
Yeah. So what we do is we follow up with paying agents and trustees for those bonds as the ones that have near term debt service payments due, and to confirm whether or not the funds have been received by them. Often these are national banks that have offices elsewhere. So even if they have facilities in the immediate area that would normally handle the issues there, they have redundancies. And to the extent that, as Mike said, to the extent that an issuer, for whatever reason, cannot physically make the payment due to access issues or loss of power, whatever it may be, we stand by ready to make those payments if necessary, and then we would get reimbursed once the issuer has the ability to make that payment.
So something probably a little less common than it was decades ago, but still something that has to be thought about, and there have been issues and situations. So we appreciate your watching that.
Certainly.
So let's go ahead and talk about once the storm hits and you can start to assess the damage. What's your follow-up?
So it really depends on the severity of the storm and how widespread the damage is. But to the extent that an issuer or group of issuers that we've insured have been affected, we do follow up with them, when appropriate, to assess how much of the potential revenue base for our bonds was affected. As Suzanne mentioned earlier, really for utility or revenue bond issuers can be severely impacted. So we try to assess whether that's the case or not. Technology has helped that a lot recently, because you can get a lot better information in terms of what areas have been impacted and to what severity. But in the extreme cases, we do, and we have gone and made site visits to really see what happened on the ground after an event.
And are there any correlations, like what kind of things in the underlying infrastructure in a community are you looking for that can help determine whether it's going to be a positive or more challenging outcome?
Yeah, I mean, really, topography is a big issue. Elevations and where property is located, or revenue-generating facilities, how far they are from the coast, or how much above sea level they are. But also, building codes are a big factor. As most people probably know, following storms like Hurricane Andrew in Florida, building standards and building codes were really improved, and so there's been a lot less impact in certain areas than maybe there would have been if you had looked back, a couple decades earlier.
I think that's an interesting point. There's kind of a feedback loop, right? The fact that we're out in the field doing these kinds of post-storm evaluations, I assume, helps inform the underwriting up front as we're looking at new transactions going forward.
Certainly, and we've done a lot of research, and in Texas, in the Houston area, there have been lots of improvements regarding building codes and how high above sea level certain homes need to be raised, and how high above the floodplain, and so that there was really it has been borne out that the homes built to better standards really fare better when there's an event.
And one of the other things that we work with, BAM is a member of the National Association of Mutual Insurance Companies. They've got a coalition called the Build Strong Coalition, which I know is kind of promoting model building codes across communities in storm and flooding affected areas to help make that more universal, so something that people can adapt at the issuer level to help manage their risk and ultimately manage the cost of their debt at some level. Once the storm makes landfall, how long is your team engaged? How long does it take to really figure out what the impact is?
Yeah, again, that also really depends on the nature of the storm and where it's hitting. Sometimes we can very quickly ascertain that there really has not been that much damage, certainly not to the extent that would impact the issuer's ultimate ability to pay their debt service over the long term. Sometimes it takes a lot longer if it's a more widespread type of storm or event. It may take longer, and that's where, as I mentioned earlier, sometimes it even takes going down locally and talking to local officials and really seeing for ourselves what happens. So it really depends, but it could be anywhere from a day or a few days to much longer than that.
Okay, so I think at this point in the conversation, I'd like to bring Laura Levenstein into the talks. Laura, thanks for joining us. Can we move up to a little bit of a higher level and talk about how BAM identifies kind of on that moment of first impression when a transaction first comes in the door, whether a discussion about natural disaster risks is warranted?
Yeah, I mean, we start at a transaction level and have a number of screening tools that we use that determine whether or not that exposure, that transaction may expose us to a lot of cat risk. Particularly, we're looking at risks where there may be a high severity of loss in the event of a cat event, because those are risks that we really don't want to take. So if we think the severity risk is going to be very high, even if the frequency is low, we probably would avoid those risks in a lot of cases. For each transaction, we have screening tools. We also have tools that allow us to look at both the likelihood and the severity of loss under different different modes, under different scenarios. And we will reject transactions that have a high severity of loss potential, and a reasonably high likelihood of reaching that potential.
So for transactions where there is a risk present, but it doesn't hit that threshold where it's uninsurable, how do you factor those into your management of the overall portfolio?
Yeah, no, that's a good point. For the ones that we do insure, I think we take a portfolio approach to it. So we have a number of tools internally that we use to look at the portfolio level cat risks that we're exposed to. We do assign to each transaction that we think has some cat risk, a sort of cat risk metric. That cat risk metric sort of identifies in rank orders the degree of exposure we have or degree of risk, cat risk that transaction is exposed to. Those cat risk metrics we then use to sort of aggregate credits across geographic regions that may be exposed to similar risks or different types of cat risk in the same region, and we limit our exposure. So we have portfolio limits that I sort of take each cat risk and isolate them and then sort of aggregate them across geographic regions. We also have an internal capital model that we use. That's a stochastic model that, again, stresses cat exposed credits more.
So just to take that to a little more granular level, so can you talk about like what is a type of region? So let's say earthquake risks. Is there a region where earthquake risk is elevated? And
sure, earthquake risk is a hard one in some ways to think about on a portfolio level because we think about it on a credit level because we can get sort of specific forecasts or predictions, model-based predictions of potential severity of loss in the event of certain types of events. On hurricane or flooding or something we can look for, I think, more across broader geographies.
So if an issuer in a flood or hurricane-prone area has insurance, is that enough to get you comfortable?
No. I mean, I think we like to see insurance, and we like to see insurance effective, that maybe covers an interruption period if there's some disruption in services, whether it be a school or a utility, whatever it may be. But I think insurance alone doesn't get us over the hurdle. We have to be comfortable that the risk is manageable.
And what I assume it's in the same category. FEMA is obviously a major factor in a lot of these communities in helping people rebuild. Is that something that BAM relies on?
Yes and no. I mean, I think there's a degree of moral hazard in relying on FEMA to always be there to sort of rescue municipalities. I think FEMA is getting more reluctant to do that. Is starting to take sort of a harder line. If you expose yourself repeatedly to certain events, they may not necessarily be willing to sort of fund municipal reconstruction.
And so, Mike, just circling back to you for one last question, can you give us some examples of major disasters that impacted BAM insured issuers, and how are they doing today?
Sure. So, a major one was Hurricane Harvey back in 2017, which impacted the Texas coast, primarily the Houston MSA, which is an area where we have, a significant amount of exposure. And while there were some neighborhoods that were much more affected than others, I would say overall the rebound has been pretty dramatic. And a lot of that is due to, I think, improved building standards. So certain neighborhoods really were not that affected. And while others were, the demand for housing, the economy, and just general resiliency and state and federal programs that helped folks on the ground really resulted in a pretty strong rebound.
Great. Well, I think we'll leave it there. Thanks for listening, and thanks again to Suzanne Finnegan, Laura Levenstein, and Mike Weinstein for joining me for the Muni CreditCast from BAM Mutual. We'll be back on the last Wednesday of every month, so subscribe wherever you get your podcasts. BAM Mutual is rated AA with a stable outlook by S&P Global Ratings, and we've helped finance more than $150 billion of essential infrastructure, including roads, bridges, water and sewer utilities, schools, and many other projects across the United States. For more information or any suggestions for future topics, please email us at creditinsights@buildamerica.com.